March 4th, 2025, Sterling Heights, Michigan. A small kitchen with white cabinets and a coffee pot hissing on the counter. Frank Novak sat down at the table. He had just turned 74. He was a retired Chrysler foreman. He had worked for 39 years. His hands still smelled like steel and oil some mornings. In his hands he held a letter from H&R Block. This was the tax return his daughter had helped him file 2 weeks earlier. Page 2 held a number, $26,400, $26,400. That was the federal income tax Frank owed for the year 2024. He had not spent that money. He had not lost it in the stock market. The United States government had forced him to pull that money out of his retirement account. Then the government had taxed the money as if Frank had earned it on a paycheck again. The reward for saving a lifetime was a tax bill. His wife, Joan, came into the kitchen. She was 71. She had been a school cafeteria manager for 31 years in the Warren Woods School District. She set down her coffee mug. "How bad?" she asked. Frank slid the page across the table. Joan looked at the number. Then she looked at the kitchen window. Then she looked back at Frank. "Where did we go wrong?" she said. Frank kept his eyes on the page. "We did not," he said. "We did everything right. That is the problem right there. That is the moment I want to start with tonight. Because I have spent the last 2 years inside the lives of families like the Novaks. I have read their tax returns. I have sat at their kitchen tables. I have watched their faces when they see the number for the first time. And I can tell you, with 100% honesty, the retirement tax system in this country is not what most families think it is. It is harder, colder, and far more expensive than any brochure ever told you. My job tonight is to walk you through what is happening to the Novaks and to families just like them, the exact rule, the exact dollar amount, and what you can still do tonight from your own kitchen table, even if you did not start 10 years ago. Let me say this in plain English so the IRS cannot hide behind jargon. There is a rule in America called the required minimum distribution. People in the tax world call it the RMD. The RMD is the government's way of saying, after you turn 73, you no longer get to leave your retirement money alone. The government makes you pull money out of your retirement accounts every single year for the rest of your life. They pick the amount. You do not get to choose. And when you take that money out, they tax it as regular income, just like a paycheck. If you saved a little, the tax is small. If you saved a lot, the tax can ruin your retirement. The harder you worked, the harder the IRS hits you. That is the truth about the year 2025. Before I go further, leave a comment. Tell me your age and tell me your state. I read every comment and I use them to plan the next videos on this channel. Now let me show you the lie. The lie most retirees believe tonight without knowing they believe it. Most people in their 60s and 70s believe their IRA is their retirement safety net. They believe the money they saved through their working years will stay safe and pay them a small amount every month and never run out and never get touched. They believe the IRA or the old 401k is their reward for saving. That is the comforting belief. I am going to break it open for you in the next 4 minutes. Stay with me. This part is the most important part of the video. An IRA is not a piggy bank. It is not a savings account. It is a tax-deferred account. That single word deferred is doing all of the damage. Deferred means you owe the tax later. You do not owe it today, but you will owe it. And you will owe it on every dollar you ever saved. The longer you live, the bigger the bill grows. The IRS waits. Then it sends you the bill. Now let me walk you through how the rule actually works in real life. The required minimum distribution is written into federal tax law. It sits in Section 401A(9) of the Internal Revenue Code. It was updated in December of 2022 by a law called the Secure Act 2.0. When the law changed, 2 things changed for retirees all over America. First, the age the rule began moved from 72 to 73. That took effect for the year 2023. Second, the age will move to 75 in the year 2033. So every retiree watching tonight, your RMD clock started between 2023 and today, depending on the year you were born. When the clock starts, the IRS gives you a table. It is called the Uniform Lifetime Table. It tells you what percent of your account you must take out each year. The percent goes up as you age. At 73, the factor is 26.5. That means you take the total account balance and divide it by 26.5. Whatever the number is, that is what you must take out. You have no choice. You cannot roll it back into the account. The government requires you to pull it out. For Frank Novak, the math looks like this. His IRA at Fidelity holds $1,420,000. $1,420,000 divided by 26.5 equals $53,585. That was Frank's required minimum distribution for the year 2024. He had to take it out of the IRA before April 1st of 2025. But Frank did not just have his own IRA. Joan had a 403B from her school district, $660,000. Joan is 71. Her RMD clock has not started yet, but in 2 years, when Joan turns 73, the IRS will require her to take $24,906 out of her own account. Right now, in 2025, the family gets a small break. In the year 2027, both clocks will be running at the same time. Now, you have to understand one more thing. The required minimum distribution does not arrive alone. The moment that money hits your bank account, it joins your other income. It joins your Social Security. It joins any pension or interest you have. The IRS adds all of that together and the total becomes your adjusted gross income. Then 3 things happen at the same time. First, your tax bracket climbs. The more income you show, the higher the bracket the IRS uses. At $1,420,000 in your IRA, your RMD alone can push a couple from the 22% bracket into the 24% bracket or higher. Second, your Social Security becomes taxable. There is a federal rule that says once your other income crosses a threshold, up to 85% of your Social Security check becomes taxable. That is not a small number for a family like the Novaks. That can be $15,000 a year or more that suddenly counts as income they did not expect to count. Third, your Medicare premiums jump. There is a separate rule called IRMAA that stands for Income-Related Monthly Adjustment Amount. The Social Security Administration reads your income from 2 years ago and decides what you pay for Medicare Part B and Medicare Part D. The more income you show, the more you pay. A retiree couple can pay close to $5,000 a year extra in Medicare premiums just because their RMD pushed them over a line, and that is just the federal part. The state of Michigan charges 4.25% on top of every dollar of retirement income you take. There is no exemption for required minimum distributions. The state taxes your RMD just like a paycheck. Let me do the live math for you now. Stay with me. This is the part that wakes people up. Frank's required minimum distribution for 2024 was $53,585. Federal income tax on that money, after accounting for the smaller standard deduction once their RMD pushes them into a higher bracket, comes out to roughly $12,600. When Joan's RMD clock turns on in 2027, add her $24,906 to the same household income. Federal tax on the RMD money alone jumps to around $21,000 or more. Add the Social Security that becomes newly taxable in those years. Add about $8,000 more in federal tax. Add the IRMAA surcharge once Medicare sees the higher income from 2 years ago. Add about $3,800 more. Add Michigan state income tax on the RMD dollars. Add about $3,600 more. Total federal and state tax directly linked to the RMD rule before Frank and Joan spend a single dollar of their own money, around $37,000 a year. That is the same number as a brand new car. Gone in tax. Not because they spent it. Not because they invested badly. Because they saved too well. That is the trap. Let me show you the same rule through 3 other families. I want you to see who the rule actually hurts and who the rule does not touch. Family 1, the Hendersons. $200,000 across one IRA, RMD at 73 is about $7,500. Federal tax on that at a 12% bracket is around $900. Painful, but not deadly after a long working life. Family 2, the Bergmans. $500,000 across one IRA, RMD is around $18,800. Federal tax on the RMD around $3,700. Add Social Security becoming 15% more taxable, $1,800 more. Total tax paying around $5,500. Manageable but real. Family 3, the Marshalls. $1 million across IRAs. RMD at 73 is around $37,700. Federal tax on the RMD around $8,800. Social Security cost around $3,500. IRMAA surcharge around $2,400. Total around $14,700. Starting to hurt. Family 4, the Novaks. $2 million across IRA and 403B. RMDs combined start around $78,400 for Frank alone, then drop to roughly $103,000 once Joan's clock turns on. Federal tax on those RMDs in the same tax year around $21,000. Social Security that becomes newly taxable, $8,000 more. IRMAA surcharge, $3,800 more. Michigan state tax, $3,600 more. Total around $37,000 in new tax inside the same household, same year, same rule. The math is not linear, the math is geometric. The harder you saved, the harder the IRS hits you. There is no medal for saving in America. there is a tax bill instead. That is why the people who did the right thing often lose the most. Right now, drop a comment. Tell me your total IRA balance, even a rough number. I use those numbers to plan the next video. Now let me explain why your state matters, because the IRS is not the only one charging you. The state you live in charges you on top. Florida has no state income tax at all. A retiree in Tampa with a $1 million IRA pays federal tax only. That retiree saves roughly $4,000 a year just for living in Florida. Over 20 years of retirement, that is around $80,000 kept in the family that would have gone to the state. Texas has no state income tax. Same benefit. A retiree in Dallas or San Antonio with a $2 million IRA keeps roughly $100,000 more over 20 years of retirement. Pennsylvania charges 3.07% flat. A retiree in Pittsburgh with a $1 million IRA loses about $19,000 over 20 years to the state. Michigan charges 4.25% flat. A retiree in Sterling Heights with a $2 million IRA loses around $60,000 over 20 years of state tax alone. California taxes retirement income as regular income, with brackets that climb above 9%. A retiree in San Diego with a $2 million IRA loses more than $100,000 over 20 years to California state tax. New York hits even harder, with top brackets crossing 10%. A retiree in Westchester with a $2 million IRA loses over $120,000 over 20 years to New York state tax. So where you retire and when you retire there decides whether the IRS pays you a small favor or steals another year of your life. The Novaks cannot easily move. They have grandkids in Royal Oak, but you might. And any adult child watching tonight could be making a different state choice for their own retirement in the next 10 years. Keep this in mind. Let me give you the strategies that actually save families. And I want to be very clear here. I am not your financial advisor. I am not your CPA. I am a retirement watchdog. These are the moves real CPAs and estate attorneys use for clients just like the Novaks. You still need a real professional in your own state. But these are the moves. The first move is the Roth conversion. Before the RMD clock starts, you can take money out of your traditional IRA and pay the income tax now at a lower bracket, then move the money into a Roth IRA. The Roth IRA does not have required minimum distributions during your lifetime. You pay the tax once. The money grows tax-free. For a family like the Novaks, every dollar converted between ages 66 and 72 can save 40 to 50 cents on the dollar later. The Roth conversion is the single most powerful move families like this never hear about. Most of them never hear the words Roth conversion until their CPA says it in the second half of their 70s. The second move is the Qualified Charitable Distribution. After age 70 and a half, you can send up to $105,000 a year directly from your IRA to a qualified charity. The money never even enters your bank account. You do not owe income tax on it. It satisfies your RMD. It helps a church or a food bank. For a couple in the 24% bracket, that is around $25,000 in tax avoided in a single year. The third move is asset location. Put your growth investments in the Roth. Put your safe investments in the traditional IRA. This way, the traditional IRA shrinks slowly and your RMDs stay smaller. The Roth grows tax-free and never forces a withdrawal. The fourth move is the inherited IRA trust. Your adult children, the ones who will inherit your IRA, will face the 10-year rule. Under the Secure Act of 2019, most non-spouse beneficiaries must drain the inherited IRA within 10 years. If they drain it in a single bad year, they pay taxes at their top bracket, often 35 or 37%. A properly drafted trust, called a conduit trust or an accumulation trust, can spread the withdrawals across 10 years and keep your kids out of the highest bracket. The fifth move is timing. Most families wait. They tell themselves they will deal with it next year. That is the second largest tax mistake in America, right behind the first mistake, which is never hearing about Roth conversions at all. Now let me show you what waiting costs in real dollars. If the Novaks wait 1 year before doing any planning, they lose roughly $9,000 in avoidable federal tax on Frank's IRA alone. They also lose the chance to do a Roth conversion at the lower bracket they would have had 12 months earlier. If they wait 3 years, they lose around $31,000 in avoidable federal tax. By then, Jones' clock has started too. Both clocks run in the same household in the same year. The pain doubles. If they wait 5 years, they lose around $64,000 in avoidable federal tax. Both spouses are above 73. Both clocks are running. Social Security is taxed 85%. IRMAA is at the top tier. Michigan has collected thousands more, and the kids will inherit an IRA they will likely drain in 1 bad year and pay 35% federal tax on what is left. This is why the cost of waiting is not a small number. It is a family number. It is the down payment on a grandchild's college fund. It is the last 5 years of vacation with the woman you married at 20. Here is what you can do tonight. You do not need a financial advisor in the room. You need a piece of paper, a pencil, and one adult child on the phone. Step 1. Pull every retirement statement you have, every Fidelity statement, every Vanguard statement, every TIAA statement, every Schwab statement, every old employer 401k statement, lay them on the kitchen table. Step 2. Add up the full balance of every traditional IRA and every old 401k. Do not include the Roth IRA, only count the tax-deferred accounts. Step 3. Pull out the IRS Uniform Lifetime Table. Find the factor for your age next year. Divide your combined balance by that factor. That number is your projected RMD. If your projected RMD is more than $30,000, you have an exposure worth spending an hour on tonight. Step 4. Call a CPA in the year 2025. Not a bank rep, not a Fidelity advisor, not a free consultation. A CPA who charges by the hour and works on retirement taxes in your state. Ask for a Roth conversion analysis covering the next 4 years, before the RMD clock starts or before it gets worse. Step 5. If you are over 70 and a half and you give to a church or a synagogue or a food bank, ask the CPA about the Qualified Charitable Distribution. It satisfies the RMD. It avoids the income tax. It costs you nothing extra. You are going to give the money anyway. The QCD just stops the IRS from taxing it twice. Step 6. Pick one adult child. Sit them down. Tell them the full number, not your income, your asset. Because within 10 years after you die, they will be on the hook for the same RMD tax under the Secure Act. They need to know now, not at the funeral home, not at the reading of the will. Step 7. Make a 5-year written plan before December 31st, 2025. Pin it to the refrigerator. Review it in November of every year after that. The IRS does not give extensions on required minimum distributions. The deadline is December 31st every year. Miss it by 1 day and the IRS penalty is 25% of what you should have taken out. Yes, 25% on top of the tax. That is in the Secure Act 2.0 itself. Let me close this with what I actually want you to remember. This is not about money. This is about family. Frank Novak married Joan when they were 23 and 20. They have a son named David, who is 48 and lives in Indianapolis. They have a daughter named Karen, who is 45 and lives in Royal Oak, 10 miles up the road. They have 4 grandchildren. Sophie is 11, Ben is 8, Lily is 6, Sam is 3. Sophie does not know what an IRA is. She knows what a basketball game is. She knows what a Sunday morning pancake breakfast is. She knows what a hug from Grandpa is. Frank and Joan built that $2 million retirement so Sophie and Ben and Lily and Sam would have a better start in life than Frank had when he started at Chrysler at 21 with one good jacket and a bus pass. The IRS treats that money as ordinary income. The Secure Act treats it as a 10-year draining problem for the grandchildren. Michigan taxes it at 4.25% every January. The wealth Frank died to build gets chipped away by rules Frank never read. That is the cost. And the cost is not a number on a page. The cost is a family. That is what this channel exists to fight. Not the IRS, not the law, the silence. The silence in your family at the kitchen table when somebody says the number out loud and nobody knows what to do next. I want that silence to stop tonight. Right at your table. If this video helped you understand your own family's RMD exposure, do 3 things right now. Subscribe to this channel. We publish 1 new retirement watchdog video every week. Hit the bell so you do not miss the next one. Leave a comment with your age and with your state. I read every single comment. I use them to plan the next video on this channel, and send this video to the one adult child in your family who needs to see it before December 31st. That text takes 30 seconds. It might save your family $100,000 or more. Next week, I'm going to walk you through the inherited IRA tax bomb, the rule your adult children will face the moment the funeral ends, the Secure Act 10-year rule, why most families lose 50 cents on the dollar of what they thought they were inheriting, and what one trust clause can do to keep the money inside the family for another generation. If you have a living parent over the age of 73, the next video is for you. Make sure you are subscribed so you see it the day it drops. Until next week, do not let December 31st sneak up on you. The RMD clock does not pause for birthdays or anniversaries or grandkids' graduations. It runs every year you are alive. The only way to slow it down is to plan ahead. In plain English, tonight. I will see you next week.